Good day, everyone. This is the continuation of recording business transactions that we have started last time, and this is the second part. Remember, the first part was all about journalizing and recording of business transactions, and of course, prior, we actually tackled some sort of introductory items to journalizing transactions. And now we are going to proceed to the next parts, which are the recording of transactions. After this would be the ledger. So this is actually posting now. The posting process, remember, is the process of transferring the entries, the account titles to be more specific, and the amounts from the journal entries to the ledger or general ledger. So basically, this is now the second major step of the accounting process, all about the posting to the ledger, and to be followed by preparation of trial balance. So expect that such will be discussed later on. All right, let's begin formally. So ledger. The ledger actually is the complete form of a T account that you have known from previous lessons. So a ledger basically is a summary device that will determine the balance or balances of different accounts or various accounts. And as said, a ledger is the book of final entry because this is the time in which the balances will be forwarded to other reports to be processed later on and to become parts of financial statements. A general ledger, as defined, is the reference book of the accounting system and is used to classify and summarize transactions and to prepare data for basic financial statements. That's correct, as said also. Then you should know that in terms of phases of accounting, remember we have recording, classifying, summarizing, then communicating and interpreting. So those are the five phases of the accounting process or processes. Now, for the said phases, we are done with the recording, which is the journalizing of transactions. Posting is under classifying. Well, the next steps will be under summarizing. The accounts in the general ledger are classified into two general groups. We have the balance sheet and the income statement. Balance sheet is also known as permanent accounts because these are the accounts that would remain after we close all the number two accounts, which are the income statement or temporary accounts, namely income and expenses. So we will know in step 7, or depending on the book again, closing entries or preparation of closing entries, wherein the income statement or temporary or nominal accounts, income and expenses, as well as a drawing, meaning the withdrawals of the owner, will have to be closed to the capital account. While number 1 will remain. So they're also known as real accounts, the accounts found on the statement of financial position or the balance sheet. We have assets, liabilities, and owner's equity. We have to remember that for each account title that is under the accounting element, so for assets again, we have a lot of account titles under, there has to be a separate ledger account for each. Let's say for cash on hand, for cash in bank, for petty cash fund, for accounts receivable, inventory, supplies, and etc. So there has to be a different ledger account for each. And then this will organize, will summarize the information contained on each T account. All right, next would be the chart of accounts. The chart of accounts basically is the list of all accounts that are expected to be used by the organization in the recording or journalizing as well as posting of the transactions. So you can see here for our sample company in the book, we have Weddings R Us, charts of accounts or accounts. So we have the balance sheet accounts and the income statement accounts grouping. So you can see here under the balance sheet accounts, we have assets down to owner's equity and income statements for income and expenses. You can also notice that for owner's equity, withdrawals basically is part of it. And take note again of how do we make use of the account title. So we have the last name of the owner or proprietor, comma, capital, as well as for the withdrawals. And going back, so the chart of accounts is a list in order of the classification. So no wonder I told you from the very beginning that familiarize the order of the accounts, assets, liabilities, owner's equity, income, and expenses, because this will be utilized as we go along the way or all throughout the discussions. Then the chart is arranged in the financial statement order as said, from assets to expenses. The account should be numbered in a flexible manner to permit indexing and cross-referencing. So if you can recall, when we discussed journalizing transactions under PR, which means posting reference or page reference, by the way, you call that also folio in some books. So that's going to be the same. Well, allow me to go back to that part so that we can visualize. All right, so here it is. We have here again PR, page reference or posting reference. So whatever is the code from the chart of accounts, this will have to be placed here. By the way, account titles and explanation also can have particulars. So some books will use particulars here, while PR could be folio. So if you can notice at this point, when we discussed the journalizing of transactions, we did not place anything here yet because this was not that important. However, I even told you that the codes from chart of accounts will be placed here. So now let us go back. So let's say cash and Perez Manalo, capital. So what codes will have to be placed? So for the debit side, we are going to place 110 for the cash. And for the capital, that will be 310 for the credit side. So that's how easy it is. It will permit indexing and cross-referencing. So we can see that, oh, that's the code that is used and so on and so forth. Now, also a very important thing to take note here is that this chart of accounts is not going to be an exhaustive list. If we say exhaustive list under our meanings, especially in our field, we mean that this is not something to be treated as a complete list of account titles. So there can be many account titles not yet listed here, but as we go along the way, as we make transactions for the business, then we have to adjust and develop and add more account titles on this particular chart. So that's why again, as said here, it has to be flexible because for example, we have now additional, let's say income or revenue account. So let's say there's one here. So what would be the code? It could be 430, right? Or the next would be 440 and so on and so forth up to, let's say 49 something because this is now 510. So this is the manner of the system. It depends though upon the organization, but I like this because this is clear cut and easier to follow. Like assets would be 1, liabilities 2, owner's equity 3, income 4, and expenses 5. And let's have the formal posting process. So to post is simply to transfer the amounts with the appropriate accounts from the journal to the ledger. So debits are to be posted as debits and credits are to be posted as credits. That's simple. So to post, you can see here, a good thing that the journal is shown also so that it will be easier. So here are the steps, but I'm going to mention them anyway as we have the set illustration. So we have here the journal and we have the posting or page reference. Remember 110 and 310. So to post, we can be guided that it's 110. So we go now to the cash account ledger and the Perez Manalo Capital ledger. Then to post, we just have to look into the account in the journal and the side. So let's say cash debit 250,000. So from there, we go to the ledger debit also. So we have here the date and then 250,000. Then for the capital, so 250,000 credit, and we have to place that 250,000 credit. So that's how it goes. So just simply transfer. Then to compute the balance, that is just, for example, a matter of adding or deducting. So in mathematics, remember, if we are going to combine like terms, let's say like terms are having the same signs, then we are going to add. Similarly, here in accounting, if we are having the same sides, meaning both debits, both credits, we are going to add. But if they are having different or opposite sides, let's say debit and credit and debit or vice versa, then we are going to deduct or net the said amounts. And of course, any number deducted with 0 equals the number. All right, so this is very important though. We have to take note as to the normal balance of the account, because that would be the controlling aspect. So let's say cash, the debit is the normal balance or side. So this would be our guide as we are going to move along the way for the different dates and place. For example, the next transaction would be May 2, but we do not repeat the month again. So that would be 2, and it is a credit of 10,000. So that's going to be a minus. So 250,000 minus 10,000 is 240,000 balance. So we will be guided as to the normal balance. Likewise, for the capital, since it has a normal balance of credit, so anything that is placed on the debit later on will have to be deducted. And for the credit, such will be added. For cash, all debits will be added to that. All right, so hopefully that's clear. This is a sample of a ledger account, which is really the, let's say, document format or form. Because if we say the ledger accounts after posting, so what is shown here actually are the T accounts, because, well, if we don't have this form or paper, so it will be very challenging to put the line. So that's why we can just make like T accounts though to be able to post, and we can determine the balance. Now, here are the ledger accounts after posting. So as said again, if, for example, they have the same sides, we are going to add, and then we should know like which side is the normal balance. Then we should know which side is greater, because that will be our control. So example here, if the debits sum is greater than the credits, meaning the account has a debit balance. And then if the credit is greater than the debit, so the said account has a credit balance. Let's continue. So here are the T accounts of the company. If you can notice, they're arranged actually from assets, so cash, down to office equipment, liabilities, notes payable up to unearned referral revenues, capital, so assets 1, liabilities 2, capital 3, withdrawals, we can label that as under 3, so that's going to be 3.1. Consulting revenues, that's going to be 4, and expenses would be 5. So they are also arranged. Another one, we can notice here that the account titles are placed on the middle of the T. And obviously, this is called, or they are called T account or account respectively, because it or they look like or resemble letter T. So that's why the origin of the term T account. Then we can now begin the posting. So again, whatever transactions that happened and recorded first in the journal, you have to transfer them one by one to the T account. So you can notice that the dates are arranged from the first up to the last or the recent transactions. So example, if we have now the journal entries that we have known, so we can now actually transfer one by one. So allow me to go back, for example, to the said journal entries that we've had for our example. So if you can recall, these are the transactions which are journalized. So we have here the first transaction all about initial investment. So debit cash and credit the capital account of the proprietor, who is Perez Manalo. So this is debit to cash and credit to capital. If we go back to our T account, so I have to move back and forth. So please watch. Okay, so hopefully now you can see the said T accounts. So we have to write here May, because it's the first or very first month that is placed on the T account. So you have here May 1. And then after that, so we are going to continue the process. So May 1 for cash, 250,000. And then for the capital, we have your May 1, 250,000. All right. So we now have done writing the debit and credit for the first transaction. Next, we go now to the second transaction. So this has to be testing. So take note again. All right, so hopefully it's shown now the second transaction. It's still May 1. Debit prepaid rent 8,000, credit cash 8,000. So let's go back to the T account. All right. So here, let's look. Prepaid rent, 8,000, it's still May 1. And credit cash, May 1, 8,000. Let's have another example, the third transaction. For third transaction, here, May 2. Debit cash, 210,000. Credit notes payable, 210,000. So let's go back to the T account. Here, debit cash May 2, 210,000 and credit the capital account. It's it. No, it's not the capital. It is the notes, rather. Notes payable because we're done with the capital a while ago. So May 2, 210,000. Here it is, 210,000. And then we just have to continue the process. So what are the things that we should be reminded about? It would be that if ever we are just continuing the process, these are the second down to the last transactions, we do not repeat the month. We simply write the date. It is because we are normally preparing the reports. We're assuming here that we are doing it on a monthly basis. So that's why the months are not mixed. But if we are like preparing for the quarter or for the semester or for the year, it is really possible that the months will be mixed. So that's why if it is like June, so we have to write again June or the next or the following month, then and the days. All right. So we just have to continue whatever that is. And after that, after we have written down, we have reflected like all of the entries and the amounts coming from the general journal. So what we are going to do is to determine the totals. So this process is called footing. The process of adding the amounts and getting the totals from both debits and credits is the footing process. So add all the debit entries on the debit side to get the debit total, and also for the credit amounts or values to get the credit total. And this will be shown here along the way. So you can actually get the balances. Then this is now the debit total and this is the credit total. After that, we now perform cross footing. So cross footing is getting the balance from the two totals. Now it's possible like for notes payable, you only have credit total, no debit entry, so no debit total, that is clearly zero. So that's why the balance is whatever is the amount, it's 210,000. However, for cash, which is the busiest account title, normally that's why if you are going to write down the T accounts, it should be having like the longest T account. You have to reserve a space because cash is the busiest account title. It's very liquid. It is usable for whatever transactions involving payments, involving collections, and likewise. So I've seen that a lot of students normally would have challenges for the cash account because they did not leave much space. So again, if you can notice, it's going to be very lengthy. So leave much space with more entries. Going back, so get now the difference. And take note of which side is greater. Because debit is greater, so that's why the balance after deducting 22,200 should be on the debit side, and so on and so forth. For accounts receivable, that's 12,000, which is greater for debit. Supplies, just copy, no credit entries as well as for prepaid rent, insurance, service vehicle, office equipment. For notes payable, copy, no debit. Accounts payable, credit is greater. That's why 53,000 should be on the credit side. Utilities payable, copy, 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 as well as withdrawals. No credit, so just reflect 14,000. Consulting revenues, no debit, so just add all credits. Salaries expense and utilities expense, no credit entry, so place them on the debit side and get the total. All right, so that's it for posting transactions to the T account. So hopefully you were able to get the points from this particular step. And then we will have the third step in the next video that I'm going to release. Thank you very much for listening and God bless us all.